listen-only mode.
Hi, morning guys. Jeremy here. Going to start the webinar soon. I'd like to do a sound check first. So if anyone can hear me, please probably can help me out typing in the question box. Okay, sure. Is it better right now? Volume? Okay, great. Thanks for the reply. So without further ado, we'll start today's webinar. So for today's topic, we'll be covering, giving an update on the US equity market. From where we left off the previous time was a few months ago, slightly post-Brexit, we were calling for the market to correct further, but that didn't really happen. So right now we'll give a quick update on US equity market based on the macro fundamental data, and after which we'll cover a little bit more on the emerging markets. So for the US equity market, we remain bearish overall, and the reason why is because the fundamental data themselves actually still signal a lot of weakness. And the title of this particular presentation will be called Fundamentally Flawed. And for today's presentation, we'll be looking throughout mainly on the macro data. And this chart over here shows the GDP year-on-year change chart. And this is one of the chart that we like the most. The reason why is because this data goes as far back as 1948. Just to orientate you guys in terms of what this chart is, the turquoise line is the GDP year-on-year chart, and the red bars over there are the recessionary periods. We'd like to point out over here the white line that we drawn is the 1% mark, and there's actually this very telling pattern that we have seen in the GDP year-on-year change chart, whereby whenever the GDP year-on-year falls below the 1% mark, it actually signals that the economy is either already in a recession or is going to head into one. And in total, there were 11 times that particular instances played out, and for the past 11 times, it has actually 100% accuracy in terms of forecasting for a recession. So give you guys a brief intro of what I mean by that. We take this 2000 period over here. This was during sub.com. You can see the GDP on year actually reached a peak here around 5% back in 1999. And subsequently, once you see the GDP growth actually start to decelerate tremendously, and once it dips below this 1.2% mark, it actually signals that the market or US economy is already in a recession. Same thing happened during your subprime period. The peak in the GDP on year actually came in around 2004. Same thing at around sub 5%. And once the growth actually decelerated, and you can see over here, once it dips below the 1.2% mark, you can see the US economy actually enters into a recession. So moving forward, we look at where we are right now. Since 2015, the trend has actually picked up, and since then you can see the GDP year on year has actually trended lower, and we haven't actually seen any high from there on. The most recent reading on the GDP year on year stands at 1.2%, which is not too far away from the 1% mark that we actually deem to be a critical line. A critical line in terms of telling us whether the economy is actually expanding or contracting. And so moving forward, looking at the Q3 and perhaps Q4 data on the GDP, that should pretty much decide whether that the US economy is going to continue to expand or give us more signal that it's going to head into a recession. So do look out for the GDP data coming forward, whether it dips below this 1% mark or not. That will be very critical in terms of telling us what the market outlook will be like moving forward. And after talking about the GDP, the big component itself, we like to break the GDP component into the smaller subset and talk about the consumption, investment component, as well as the manufacturing side later on from the following slides. We'd like to touch on the GDP investment component right now here. And this is the GDP investment Q on Q chart on the lower panel. And on the upper panel, we have the S&P 500 chart. So you can see over here the correlation of the S&P 500 and the GDP investment Q on Q chart is actually quite positive, and each of them tracks the move pretty closely. So the interesting thing over here is you can see over here back in your .com and subprime high. Once the GDP investment quarter-on-quarter change actually picked over, you can see it actually mirrors a market top in your .com and subprime period pretty perfectly. And during subprime, it actually gave us quite an early warning signal for the market correction. The peak on the investment Q on Q actually happened in Q1 of 2006, giving the market about 1 year or so before it tops over. So the current picture of the GDP investment Q on Q shows us that the investment picture is actually topping over again. We have seen over here back in Q3 of 2015, that was where the peak was formed. And since then, we haven't actually seen a newer high in the investment Q on Q picture. So if this correlation were to hold itself, and if the peak of the GDP investment Q on Q actually spells out subsequent market tops, we could very well be actually entering into a similar period like the .com and subprime. Okay, moving forward, we'll talk more about the manufacturing side of the equation. Here's another chart that we like a lot. This is the industrial production year-on-year change chart. And why we like this a lot is because this data goes as far back as 1920, giving us ample empirical evidences of how this industrial production actually signals a recession. So same thing over here, the red bars show the recessionary period, and the turquoise line over here shows the industrial production year-on-year change chart. We have actually drawn a zero line, and anything above the zero line means expansionary period, while anything below the zero line represents contractionary period. And just to give you guys a brief understanding of what the industrial production is, it basically measures the output of industrial estimates in the establishments, in the mining, quarrying, public utilities, and manufacturing industries, and is often regarded as a leading indicator of economic wealth. You can see the characteristics of this particular industrial production is whenever this industrial production dips below the zero line, meaning it goes into a contractionary period, it usually signals that the economy is either already in a recession or is heading into one. And throughout history, back from 1920, there were 23 occasions whereby the industrial production actually fell below the zero line, and out of which 6 failed, and the rest actually called for a recession, implying a 70% accuracy of forecasting a recession. But we actually did a deeper study in the industrial production and looking at the failed signals. The failed signals are shown by the highlighted box over here, and the subsequent ones similar in the highlighted boxes. And we actually found out that the longest period for the failed signals that stayed below the zero line was 4 months, which happened around 1930s over at this highlighted area, as well as around 1940s period over here. 4 months was the longest that it stayed below the contractionary period before it bounced back above. And the subsequent ones are just a 1 month fall below the zero line, giving us a short run below the contractionary period. So keep in mind the 4 months period that states for a failed signal. And moving forward, here we are right now. The industrial production year on year is actually contracted for a whopping 11 months, way more than the 4 months of the failed signal that we mentioned just now. So just to let you guys know, the contextual view of 11 months should more or less signal that the market is ripe for a market correction or actually heading into recession real soon. And you can see over here, back in around 2009, the industrial production has actually found its peak, and since then it has actually trended lower, and like I mentioned, stayed below the zero line for the past 11 months. So what are the implications of the industrial production actually falling below the zero line? We'll take a closer look here. We overlaid the S&P 500 on the top panel over here, and the bottom panel over here shows the industrial production year on year. I've actually annotated the zero line again over here, and the vertical lines mark the area whereby the industrial production year on year actually falls below the contractionary period. And you can see over here, every single time when that happens, it sort of accelerated the stock market correction. Same during a .com as well as your subprime period over here. So this is just to illustrate the zoom in view of the current environment, how weak this industrial production year on year actually is. And this is the 11 months that I've actually mentioned here. And if we were to continue to see this contractionary period hold out, there is a high chance that the S&P 500 is overdue for a market correction, probably in the magnitude of the dot-com and subprime period. Another manufacturing indicator that we like to look at is the ISM manufacturing PMI data. And basically this is a survey that tracks sentiment among purchasing managers in the manufacturing industry. And a reading above 50 represents expansion, while a reading below 50 represents contraction, shown by the white line that I've drawn over here. So there is actually quite an interesting pattern that plays out in the ISM manufacturing PMI that signals for recession. It tends to dip below the 50 line into a contractionary period at first, giving us the first sign of weakness, which is the first warning that I've marked up, shown by the highlighted box. So whenever we get the first warning, the market just falls in a small bleed around this area over here and subsequently rebound off. But what is the key for the ISM PMI is once we get the second confirmation, which means the second fall below the 50 line into contractionary period, you can see it marked the top in the dot-com perfectly, as well as the subprime period. The first warning came in at around 2006 period, where it briefly dipped below the 50 line and subsequently rebounded off. But ultimately, once it dips below the 50 line for the second time, which I've drawn over here to give us the confirmation that the industry manufacturing side is actually really weakening, you can see it again perfectly marked the top for your subprime period. So where we are right now, it's pretty much the same kind of picture that we have during our dot-com and subprime period. We've seen the fall below the 50, which is our first warning that we'd like to see happen back in October of 2015 last year, shown by this highlighted area. And same thing happened, it rebounded off the 50 line and started expanding again, but only marginally, which ultimately the most recent reading that came in last week shows that the ISM manufacturing PMI is actually once again dipped back below the contractionary period, and thus giving us the confirmation that we need to call for a market correction just based on this manufacturing PMI data. So if this correlation of this manufacturing PMI holds out, chances are that we will likely see a stock market correction similar to the dot-com and subprime period. Moving on to the retail side of the equation, which could also translate to consumer side of the GDP data. We have the retail sales year-on-year chart at the bottom panel, and same thing over here, the top panel is the S&P 500 chart. The critical line over here that we actually notice is this 1.6% mark. You can see whenever the retail sales actually falls below the 1.6% mark, shown by this vertical line, as well as the other one over here back in 2008, you can see it actually accelerated the dot-com correction as well as the subprime correction respectively. So to give you a general view of the current environment of the retail sales year-on-year, it's actually pretty weak. You can see the peak in the retail sales year-on-year actually was formed back in 2011, and since then it has trended lower. And right now the last reading stands at 2.3%. And moving forward, it will be key to look out for the retail sales year-on-year to actually dip below this 1.6% mark in order to confirm this bearish narrative. Next, we'll look at some of the market-based indicator. Over here, we took a look at the New York Stock Exchange margin debt, which basically means or represents the fuel for the market. And what we mean by that is, you can see every single time the New York Stock Exchange margin debt actually picked over, the market follows along. And the correlation between these two instruments is pretty perfect. And it happens same for the dot-com period as well as the subprime period. And here we are right now. We've actually seen a peak in the margin debt back in Q1 of 2015 last year. And since then, it hasn't really broke any new highs. And if this peak were to hold true and stand firm, there will be a high chance that we could see a stock market correction similar to the magnitude of dot-com and subprime period, due to the fact that the fuel is running out for the stock market and there are less buying pressure that's pushing the market to new highs. This is yet another chart that sort of mirrors the previous one I've mentioned, the kind of a positive correlation chart. Over here we show the adjusted EPS on the bottom panel. And what this adjusted EPS measures is that it basically measures the S&P 500 company earnings as a whole, and it's based on income from continuing operations excluding gains, charges, and one-time items. And hence you can see over here, it's pretty much the same kind of explanation I just showed you guys previously. The peak in the respective period back in 2007 actually formed a market top in the dot-com and subprime period. And moving on, we actually seen a similar kind of peak happening back in Q3 of 2014 over here, and since then it hasn't really found any new highs. And you can see when the peak in this particular adjusted EPS actually formed, the market actually went sideways for quite some time before only recently breaking out for new highs marginally. So with that in mind, keep a lookout on all of these metrics to see whether the peak actually holds true and if it continues to trend lower. Here's yet another chart that shows a similar kind of positive correlation. We look at the household net worth as a percentage of disposable income that is shown at this bottom panel. And explanation-wise is the same. The peak of this particular indicator mirrors the peak in the S&P 500. And looking at the current environment, it's showing the same kind of motion that the market has actually topped over back in Q1 of 2015. And that's why probably it's the reason why we see the market actually stayed range bound since the end of 2015 period, and only until recently breaking out new highs with more liquidity coming from other central banks. And now lastly, we would like to talk a little bit more on the labor market, which is something that the Fed look at quite a whole lot in terms of them forming their monetary policy. Firstly, we would like to look at the non-farm payroll, which is the headline number that most analysts look at. Non-farm payroll actually shows kind of a decent jobs market right now. Not too much happening on in terms of a weakening sign, or not too much in terms of representing a strength. Over here we can see that the non-farm payroll, we draw this particular line at this minus 15,000 lines because this is a critical line that we think that should more or less signal whether the market is heading into a correction or not. Look at this particular period back in April of 2000 as well as May of 2007, when the non-farm payroll actually dipped below the minus 15,000 line, meaning a layoff of 15,000 workers. It actually marked a respective top back in your dot-com as well as the subprime period. And moving forward, we would like to see the non-farm payroll confirming this notion, whereby a fall below this minus 15,000 should more or less seal the fate for a market correction. Just to give you guys a quick view of how the non-farm payroll has been actually performing itself. We actually seen a pretty bad data came out in May this year. Employment actually only rose a marginal 24,000, but subsequently that happened to be one-time outlier, and they managed to rose back to a high of 292,000 over here back in July. However, the most recent reading that came out last Friday was actually below expectations. Expectations was standing at 180,000, but the actual figure came out at 151,000, which is why we see this particular fall in non-farm payroll over here. So the non-farm payroll tends to oscillate between this range of about 30 to 40,000 on the lower range, and on the upper range about 250,000 to 300,000. So moving forward, like I mentioned again, look out for the non-farm payroll to actually dip below this minus 15,000 to confirm the bearish narrative. However, we have other labor market indicators that suggest that the labor market isn't really all that healthy, and we'll get into it right now. Over here we have the unemployment rate, and this is yet another chart that we like a lot. Same thing over here because the data goes as far back as 1948, and the red shaded areas are the recessionary period, and the white line is the 12-month moving average, and the turquoise line is the unemployment rate. So what I want to point out here is that every single time when the blue line, which is the unemployment rate, ticks above the white line, which is the 12-month moving average of the unemployment rate, it usually signals that the market is already in a recession or heading into one. And throughout history since 1948, there were 14 times when these occasions happened. 4 failed, and the rest sort of managed to call for a recession, implying a 71% accuracy of predicting a recession. The failed signals happen in these shaded areas over here that I've actually drawn, and the rest are the periods whereby it accurately called for a market recession. So to give you guys a feel of what I mean by that, we just briefly go through the most two recent examples of how that happened. So take for instance this period over here, this is during a dot-com period. You can see when the blue line actually trails over and forms a bottom, and subsequently ticking above this white line over here. That was the first sign that the economy might actually be heading into a recession. And true, it actually happened slightly a few months later whereby the recessionary period takes over. This was during a dot-com, and same thing happened during a subprime. The unemployment rate found a low at around 4.2%, and subsequently once it takes above the 1%, the 12-month moving average, you can see over here, the economy roll over into a recession in a few months' time. So where we are right now, you can see the unemployment rate actually improved tremendously. Fell from a high of 10% back in 2009 all the way to the current low that we have seen back in May at 4.7%. However, the unemployment rate seems to be finding some bottom right now, and we are actually currently standing at 4.9% as of last Friday's data release. So the important number right now to look out for will be the 12-month moving average, which stands at 5%, which is not too far away from the 4.9% that we actually received last Friday. And so moving forward, once we get the confirmation that the unemployment rate starts ticking above the 5% mark, perhaps to maybe 5.1% or 5.2%, that should give us quite a good signal that the market or the economy is ready to head into a recession, just like what happened previously throughout history since 1948. This is another labor market indicator that we like to look at. This is the PhillipCapital survey diffusion of number of employees. Over here, you can see we drawn the line at minus 5.1% because that's the line that we deem important. You can see whenever the indicator actually falls below this minus 5.1% mark, it accelerated the dot-com correction as well as the subprime correction. And you can see the most recent trend of this particular indicator has been pretty weak since the end of 2014. It's been trending lower and has actually went into negative territory. And the first time it actually falls below this minus 5.1 mark was back in April of this year, but it managed to climb back up above, and the most recent reading take this indicator back to a new low at minus 20, which is something that we think is pretty bleak. And the last time we are actually at this particular minus 20 point, it was back in 2009 period whereby we are already in a recession. So moving forward, if this correlation holds, we should expect the market to more or less head into some sort of a correction next. And there is yet another indicator that we look at to forecast the labor market. This is the labor market condition index, which is one of the Fed favorite indicator to look at when they forecast their labor market. This indicator actually takes a look into the 18 monthly labor indicator and tabulates this particular indicator based on a certain formula. And the important line that we look at over here is the minus 2.2% mark. Same thing every single time when the labor market condition index dips below this minus 2.2% mark, you can see it actually represents or more or less forms a respective market top during a dot-com period as well as a subprime period over here. And looking at where we are right now, the labor market condition index have actually fallen below this minus 2.2% mark back in February of this year, and that should confirm that market is ready to head into a correction next. But nonetheless, the trend sort of flipped back above the contractionary period and currently stands at 1%. So to get more confirmation from the labor market condition index, a a quick way to look at it is for it to dip back below the minus 2.2% mark to get the confirmation. And once that confirmation holds true, there is actually a high chance that market correction is going to happen pretty soon. And last but not least, we'll just show you the sort of recovery that the mainstream is actually depicting. Over here, we have the home ownership rate that is shown in the pink line, as well as the labor force participation rate shown in the turquoise line. And I'd like to point out over here the vertical line that I've drawn is back in end of 2006, which is somewhere around when subprime happened. And the so-called recovery that we actually experienced after subprime was around the end of 2009. You can see since that period onwards, both of these indicators haven't actually recovered any single bit. And home ownership rate has actually plunged to unprecedented new all-time low at 63.7%, as well as the labor force participation rate currently plunging to a low of 62.8%. The last time that the labor force participation rate was at this current level, it was back in around 1978 period. To show you guys how actually strong or weak this economy really is. And hence, in summary, this is just a table to sort of give you guys a quick overview of the indicator that I've actually mentioned previously. And those indicators that I've confirmed are shown in the blue font, and those in the black font are those that haven't really confirmed the bearish narrative. Three indicators that we like the most would be the GDP year-on-year change chart, the industrial production year-on-year change chart, as well as the unemployment rate chart. So out of the three that we like the most, industrial production year-on-year has actually confirmed the bearish narrative, and the other two, GDP year-on-year as well as unemployment rate, hasn't really confirmed, but they are close to confirming the correction kind of view. So moving forward, I would like everyone to actually keep a close lookout for the unemployment rate data as well as the GDP year-on-year chart to see whether it gets below the critical line that I've just mentioned, the 1% mark on the GDP year-on-year change chart, as well as the unemployment rate above the 5% mark. And when that happens, the chances of a market correction will actually increase significantly. And just before we end, reiterate that we remain bearish on the US equity markets in general, and some tradable instruments that you can use to capitalize on the move to the downside will be some of the ETF that we mentioned over here, or the CFD instruments here. Before I end it, I would like to just show you guys the price chart of the S&P 500. And the last time we talked about the S&P 500, it was post-Brexit at this particular bar over here. We actually called for the triple top to work out, but obviously it failed quite miserably, and post-Brexit you can see prices reverse ramp all the way back up and even taking out its previous all-time high. The all-time high happened in May of 2015 last year at 2137, and you can see subsequent post-Brexit price ramped up above the all-time high, and it was only quite marginal, and as of now the S&P has only taken out its all-time high by about 2% or so. And usually for a strong bull market to actually work out, whenever we see markets breaking out for a new all-time high, the upward trajectory should continue and not sort of a stay range bound like what we have seen over here. And so moving forward, there's actually this particular trend channel that is holding price down. And what I mean by that is over here, you can see that price sort of oscillates between this range bound, sort of being defined by this upward trend channel. So moving forward, when we actually do get the breakout either way up to the upside or downside, that should more or less dictate the further movement in the price action. And in the meantime, we should expect the S&P 500 to continue to stay range bound in between this upward trend channel until a breakout happens. And with that, I'll pass on the time to my other colleague to talk a little bit more on the emerging markets and some possible bright spots within Taiwan.
Hi, morning guys. This is Sai here, covering the macro side of things. So today, after hearing what Jeremy has to say, I guess a lot of you are a bit worried, where the market will be going. No doubt, we share the same view, but there are certain markets at this point in time that we find that there's certain values that is able to at least invest in. Cause just remember that on a long-term basis, we still share the view that US is most likely in for correction sooner rather than later. And with that in the back of our mind, we try to go out and search for markets with opportunities and growth. So today, as I cover emerging markets, what I will be focusing on, as you can see, the title here is Taiwan, where we actually do see a catalyst for growth even for the longer term. So looking at asset class performance, this is how we're looking. We look into things from a top-down approach. We can see that equities hasn't been performing that well. A lot of the institutional investors, especially the big boys, they have been looking for yield within the high yield space as well as the sovereign debt and global credit space. So equity is not on top of their list. Therefore, equity markets, as I think Jeremy have explained, has remained slightly plateaued and remain sideward moving. However, of course, there are certain markets that have been outperforming. In general, I mean, we have blinked or even missed looking at the growth of this economy. Essentially, uh, essentially the Latin America, the EEMEA, which stands for East Europe, Middle East, and Africa, they've all been constant outperformer year to date. And it's not surprising to see that the bottom few or equity markets as a group, European and Japan itself is down respectively. These two countries are your developed markets as well, and these are the developed markets that are still on an easy monetary policy basis. And as central bank continues to print money, people are not really buying the story that easy money is the way to go and it will spurge the economy to spend more. And if we take a deeper look and segment it into different indexes, we can see that for the developed market side, besides the US, which has actually broken out from its all-time high as mentioned by Jeremy, the rest of the other major index has been on the negative side. If you look at Europe, the only exception is UK, but we expect it to go down. This is largely due to a price earning multiplier, nothing to do with their fundamental. So on the Asia side, Japan is a developed market, and you can see it's actually down by about 11%. So if we take a look into the other side of the world, the emerging markets, what we see here is that a huge chunk of the emerging markets will actually outperform tremendously, except for your Shanghai and your China in general, as well as within Southeast Asia context nearer to home. Singapore is not up yet, year to date, as well as Kuala Lumpur is not up yet. But you can see the rest of the other markets have been performing tremendously well year to date. And we missed the Latin American boat. We believe that now might not be the most optimal time. They are a bit overstretched in terms of valuation as well. And therefore, we bring our scope back a bit nearer to shore, which is within the Asian region. If you look at this chart here, what we're actually seeing here is actually the 12-month, the trailing 12-month price earning ratio. If you take UK outside, you can see that your Nasdaq is actually highly valued. You see, so is your Argentina, which was one of the better performing index of the year for the year. In general, if you look at the other side of this chart, on the left-hand side, deeming the cheapest by trailing 12 months, you can see that Russia, Hang Seng, China Enterprise Index, Turkey, all these considering are all emerging markets, in Taiwan as well, which we will take a deeper look later on. So this tells us that in terms of markets, right, we would rather be in the emerging markets than the developed markets at this point of time. So this is actually a table of valuation methods that we take a look for indexes. We have market cap over GDP, enterprise value over asset, enterprise value over sales, enterprise value over EBITDA, price to book, free cash flow yields, and as well as trailing 12 months multiplier price earning that we have taken a look later. So if you go to equal weight them and then give them a ranking, you can see at the top of the chart here is actually a Russian index. We won't really advise you going to that because that's a very controlled index. Russian is not really a very democratic country. And then of course we have Turkey, Korea, and Hang Seng. So just by these charts, we can see that a lot of the, although there's a few of these so-called developed markets up there, but we will not take a look. However, just to highlight Taiwan, which is a country that we will highlight, we will be more in-depth later on. We'll cover more in-depth later on. It's actually ranked about 11. This put it at actually a very sweet spot in terms of valuation. It's not overly priced, and it's not too cheap as a country, as an index. So for currency, you could see just something to highlight. Even though Brazil have done very well, you know that the currency risk, at least for the year to date, is negligible. In fact, if you have just invested within the Brazil context and then kept your currency in Brazil real, you will have actually made even a 22% more on the original. Sorry, just give me a moment. You flip back here. Brazil was up 34%. If you just kept it in their own currency, it's up another 22%. So year to date, you have actually been up about 50% in that case. So nothing much here. I will just move on. So let me talk a bit more in depth into the Taiwan market. So what happened to Taiwan? Earlier this year, Tsai Ing-wen, which is the current president, won the election with her Democratic Progressive Party. She essentially just displaced Ma Ying-jeou and Kuomintang as the ruling party for Taiwan. So at the start of the year, she essentially took office 20th May, which is just a few months ago. She just entered her 100th day of governing Taiwan. So initially, because DPP has always been a very pro-democracy party, when Tsai Ing-wen and DPP was elected as the majority government as well as the president, a lot of uncertainty was created within the market. This has ultimately affected their share price as well. As you can see, Taiwan took the fall together with the January drawdown and correction, if you all remember, and they didn't really recover since then. However, fundamentally, the economy is actually improving. I will show you some slides later. And we feel that emerging markets as well as a market itself is also garnering a lot of investment funds. Therefore, it puts Taiwan in a really nice place for, as it there's a story of a catalyst of growth, as well as the market, emerging market itself as a whole market is actually pushing up the emerging market places. So what are the investment merits? Simply there's three. Like I mentioned, new government with new economy model of growth. Number two, economy itself is already showing signs of recovery. Number three, emerging market which is on the rise. So if we take a look into the two charts here, if we believe that asset pricing is a function of your growth as well as your inflation, you can see that inflation since the start of the year has been maintaining at a very healthy rate of 1%. And as for GDP, Taiwan recently just came out of the what we consider a technical recession. As you see on year, GDP growth was below zero for 3 consecutive quarters. As of Q2, they came up with a positive close to 0.8 percentage of growth. So we can essentially mark this as the end of fundamentally Taiwan's growth will continue to improve, and we see it will continue to improve from here on. So looking at other indicators, hugely suggests that Taiwan is really out of the woods now, and with its democracy and its enterprise society, they are bound to be one of the best country within the South Asia space to perform better than the rest of its peers. So we look at industrial production year on year, it just came back from 0%. So it just started to tick up, which is in line with the GDP growth rate. Manufacturing PMI, a survey that's done, that's a little bit more forward-looking, also shows you that anything above 50 is expansionary, and the economy itself, the people or the businesses itself are expecting a more expansionary economy rather than a contractionary economy. And the below one is actually more important to us. The yellow color line or the orange color line actually shows us portfolio investments. Essentially, these are investments that are directly made into sorry, give me a minute. Directly invested into your stock market, and this will definitely drive the stock market indexes as well as all your underlying share prices. Direct investments are a bit more longer term. It represents, companies coming here to set up shops, set up offices, or set up factories to do productions and things like that. So we could see very simply on as the year comes closer, we are just going higher, and portfolio investments have actually increased from the previous 3 years. So of course, after talking about merits, we want to talk a bit about risk. So simply, we identified two risks. First is the political tension on the cross-strait with China. Because of its pro-democracy stand, a lot of people are worried that Taiwan might essentially provoke China, and an all-out war might ensue. But we beg to differ, because I think Tsai Ing-wen has been a very diplomatic person, very intelligent person. She has re-emphasize her stance of just remaining status quo, which is in line with the current view or the predecessor of Kuomintang. The second is actually what we consider the China Red Supply Chain. This is an initiative on China's part to dominate the electronic component sector and industry, which is the bedrock of actually our Taiwan economy. So if China continues to pump money into the red supply chain, they are expected to go about, the 2025 plan is to invest up to 16 billion worth of renminbi into the industry. This will essentially diminishes Taiwan's high-end electronic producer stand in the world, because currently Taiwan is one of the largest and main producer of electronic goods. So if you take a look, how dependent has Taiwan been on China? If you can look on the left-hand side of this chart, the left hand of this chart, trade balance have substantially increased throughout the years. I demarcate each bar on a 5 years period. So from a 2% to 4% to 7%, and as the end of last year, trade balance, which is export import, holds up about the net export holds about 30% of the GDP. Essentially, this diminishes the return on private investments, which is what Taiwan used to be famous for. Taiwan has a very enterprising and entrepreneurial people, and as they continue to invest within their own country, it's something like a domestic consumption. It will be less dependent on their trading export. And if you look at the right side of the chart, this is how China have actually dominated Taiwan's exports in terms of country. Because of Ma Ying-jeou's policy of focusing on China as their trading partner, throughout these 15 years, China has become the main trading partner of Taiwan. So if you look overall, Taiwan as a country, like all other East Asian country, Taiwan is an exporting nation, and on the left-hand side, you can see that they have built a very comfortable trade surplus demarcated in the gray color bars, as well as their export has been on the continuous upward trend, plateauing only in the recent years. As well, but then their imports itself has been dropping, so that gives them even a larger trade surplus. But what's more interesting is on the right-hand side of this pie chart, where it shows you that the machineries and electronic equipment component holds up more than 50% of their export. This is what I mean by Taiwan's bedrock economy is actually in the electronic equipment manufacturing. If that doesn't do well, we don't expect Taiwan's economy to do well anytime soon. And you could see on the bottom left is actually your export of machinery and electronic equipment. The same segment here, which is their largest component, has seen a positive turn up in terms of industrial production. So we could safely re-emphasize that the GDP and the growth itself seems to be recovering. On an interesting note, look at industrial production versus export to China on the bottom right-hand side. It has been moving in tandem, and the red color lines here demarcate the period of Ma Ying-jeou's administration. So when Ma Ying-jeou took into office, they decided to make China their focus of attention in terms of trade relations. As you can see, their export to China and their industrial production has moved practically in tandem. But however, after 2015, what happens was the sunflower student movement, which essentially was a protest against their close trade relation with China. Essentially, with more free trade agreement in China, this would actually harm the small and medium-sized enterprise of Taiwan. Therefore, the Sunflower Movement was there to stop the CCT agreement, the cost trade agreement. And you could see from then on, there was a slight de-link between the export to China as well as the industrial production. So we end on this with the Taiwan Composite Index and the price charting. You can see that it's actually on a very nice recovery trend, forming higher lows. And as it breaks a few of these resistance lines and aim for a higher high, we expect Taiwan, if nothing changed fundamentally with the new economical development model in process, we would see Taiwan essentially going back to most probably hitting its peak of 10,000. And fundamentally, technically, as well as politically, we all see that there's a positive story and a catalyst for Taiwan to go even further. I think with that, I will end my presentation. Here are just a few, I think, investable instruments within Singapore that you can actually get your hand on if you are interested in having a position in Taiwan. So with that, I end my presentation. Please feel free to ask any questions. A question on the prospect of stocks in Thailand, Indonesia, and Philippines. From what we can see here is that on a general market basis, Thailand and Indonesia have been climbing up rather fast. From a valuation point of view, they are slightly overvalued, but on the individual stocks, I think stock picking would have been, you have to do your individual stock selection. But on the general market scale, it's a bit pricey at the moment. Okay, let me answer the other EM question before I pass the mic to Jeremy. Yes, you can trade Taiwan ETF directly through podiums.
Hi, Jeremy here. There's a question regarding the outlook not looking good and why is the Fed talking about raising rates on September. Just to give you guys a quick view of what happened back last year in December 2015 when they actually went ahead and hiked their first Fed fund rate from 0.25 to 0.5. They actually gave a forward guidance of actually 4 rate hikes in the year of 2016. And moving forward, right now we haven't actually seen the Fed increasing their rates. And right now we are really probably somewhere near the start of Q3, and they haven't really started hiking any Fed fund rates. So the reason why they actually talk about raising rates probably in September or even going forward December is because they are not sort of having the market miss the expectation of the 4 rate hike that they talk about, and even having 1 or 2 rate hikes would more or less still fail to fulfill their promises that they mentioned in the forward guidance back in December last year, where they mentioned 4 rate hikes this year. So probably that's the reason why the Fed is still sort of looking strong or appearing strong to call for a September rate hike. But whether or not they actually hike rates this month or not, we wouldn't know for sure. But keep in mind that the November election is something that is worth noting that might actually deter the Fed from hiking rates. And if that were to hold true, probably the closest period that they can hike their rates would be after the November election would be December period.
Okay, there's a question that is actually asking whether the correction in the US market will affect Asian markets. That's with certainty, because most of the Asian markets are an export-driven nations, and a lot of this export destination actually goes to the US market. So, like I said, with a caveat when we invest in any of these emerging markets, is that if US market is to go into a correction or even a deep recession, essentially most of the emerging markets will not do well, and therefore we take a look into emerging markets, but on a longer basis, Taiwan would be the first few, essentially, if there is any recession, to come out a bit stronger and better.
Regarding the duration for the market downturn, we would like to take the benchmark or the reference from the dot-com and subprime period, and we've seen that during both instances, the downturn shouldn't last more than 2 years. And how deep will it be? Like I've shown previously in all the charts, the current environment pretty much resembles the dot-com and subprime period. And so using that as a reference point, probably we can see a market correction in the range of somewhere near 30 to 50% for the coming correction if you will play through. And there are a few questions regarding the slides. We will be sending out the slides after this webinar, so keep a lookout in your email. Okay, since there is no other more questions, we'll end today's webinar today. Thank you guys for taking time off to listen to our webinar, and see you guys next week. Oh, next week. Oh, sorry, yeah, next week is a public holiday, so we'll see you guys the following week. Yeah, have a happy holiday.